Investing can seem complicated, but it doesn't have to be. Index funds offer a simple, effective way to grow your money over time. Imagine trying to catch every single fish in a lake. That's what actively managed funds try to do. They pick and choose stocks, hoping to outperform the market. Index funds, however, are like casting a wide net across the entire lake. They aim to capture the performance of the entire market, represented by a specific index. An index fund is like a basket of stocks. This basket tracks a particular market index, such as the S&P 500. When you invest in an index fund, you're investing in all the companies included in that index. This diversification helps spread your risk. Instead of putting all your eggs in one basket, you're spreading your investment across hundreds of companies. This approach reduces the impact of any single company's poor performance on your overall portfolio. The S&P 500 is one of the most widely recognized indexes in the world. It represents the top 500 largest publicly traded companies in the United States. Think of these companies as the heavy hitters of the American economy. Apple, Amazon, Microsoft, you name it, they're likely in the S&P 500. When you invest in the S&P 500, you're investing in a slice of the American economy. The S&P 500 is a market capitalization-weighted index. This means that companies with larger market values have a bigger influence on the index's performance. Essentially, it's like a popularity contest where the biggest companies have the loudest voices. This approach makes the S&P 500 a good representation of the overall US stock market. An S&P 500 index fund aims to mirror the performance of the S&P 500 index. It does this by holding the same stocks in the same proportions as the index itself. Because of its passive approach, the S&P 500 index fund requires minimal trading. This results in lower fees compared to actively managed funds. Imagine paying a team of chefs to hand-select your groceries versus simply shopping at the store yourself. S&P 500 index funds are widely available and easy to invest in. Many brokerage firms offer their own versions of these funds. You can start investing with a relatively small amount of money, making them accessible to both new and experienced investors alike. Section 4, Active versus Index funds, a battle of approaches. Actively managed funds employ portfolio managers to select stocks and outperform the market. Think of these managers as stock-picking athletes, constantly striving to beat the competition. They conduct extensive research, analyze market trends, and make strategic bets on individual companies. However, this active approach comes at a price. Actively managed funds typically charge higher fees to cover their research and management costs. Index funds, on the other hand, track a specific market index, aiming to match its performance rather than beat it. This passive strategy results in lower fees as there is no need for expensive research teams or frequent trading. Think of index funds as steady marathon runners, consistently covering ground without the need for sudden bursts of speed. Section 5. The enduring appeal of index funds. Index funds have historically provided competitive returns over the long term. While they may not deliver the same explosive growth as some actively managed funds in certain years, their consistent performance and low fees make them an attractive option for many investors. The S&P 500, for example, has delivered an average annual return of around 10% over the past 90 years. Index funds are like the tortoises of the investment world. They steadily plod along, outpacing many of their more active counterparts over the long haul. Their simplicity, diversification, and low costs make them a powerful tool for investors of all levels of experience. Whether you're just starting out or are a seasoned investor, index funds can play a valuable role in helping you achieve your financial goals.